Good morning or good afternoon, depending on where you are. And thank you very much for joining us today for our Crypto Tax webinar. My name is Yotam Rosenbaum. I'm the head of operations at Digital Surge. And today with me is a special guest, Daniel Harrison. First, just a bit of house cleaning. Quick disclaimer, this webinar provides general information and education only. You should seek advice from a qualified professional before taking any action. And with that out of the way, I'd now like to introduce our speaker, Daniel Harrison. Daniel is the manager of the Newcastle Oracle Accounting Office and has been in public practice for 20 years. He has experience in management roles in mid-tier accounting firms and previously being a technical auditor for the ATO. He has a deep understanding of taxation law with a heavy focus on digital assets, property, CGT, proactive tax planning, and business structuring. He also has a wealth of experience in both debt and dispute management with the ATO. Daniel holds a postgraduate diploma in commerce from Curtin University and a Bachelor of Management from the University of Newcastle. Daniel, thank you very much for joining us today. The mic is yours.
Thanks, Yotam, and thanks everyone else for joining us. So as you can see from the slides, first thing we'll be doing is just a quick overview of some crypto taxation principles, just dealing with general assets, record keeping, things like that. Then we'll go into some more specific areas for self-managed super funds. Followed by that, we'll look at the impact of some of the tax events of 2023, and how they may impact your tax when it comes time to prepare. Now, at the end, we'll deal with any questions. Feel free to put any questions up as we go, and I'll try to get to as many of them as I can at the end. If there's questions that are overly technical or that I need or that I don't get to, we'll try and send an email around, covering most of those issues as well, depending on the volume of questions that come in, of course. So, as Yotam said, I'm Daniel Harrison. I'm a member of the Institute of Public Accountants. I've been in public practice for over 20 years. I began investing in cryptocurrency in late 2016. Noticed there was some not a great deal of good tax advice floating around in the space at the time. And from that, I decided to sort of have it as a niche focus, and I started one of the first firms that had advice, an advice focus on cryptocurrency and digital assets, and I ran that up until about 2020, until I joined the ATO. Now, Oracle Accounting, we're a registered tax agent. We're also financial planners. We have a financial planning division. We have 6 offices along the East Coast that are accounting offices. We have several offices down in Melbourne and around Victoria, which are focused on financial planning, but can refer to our accounting offices in the other states. So, look, as you can appreciate, taxation of digital assets is a pretty diverse area. There's lots of intricacies. What we've tried to do here is just touch on the main concepts that customers of Digital Surge would be dealing with. I appreciate there's other things like NFTs, DeFi, all that sort of stuff. We're happy to answer questions about that in the Q&A, but just as a general overview here, we've tried to focus on some very sort of specifics, just to cover off what most of the clients of Digital Surge will be sort of dealing with from a taxation perspective. So, look, most investors are going to hold digital assets on capital account. Basically, that means that all your sales are then dealt with under CGT legislation. most disposal events come under what's called CGT Event A1, but all you need to remember as a taxpayer is every single trade that you do is taxable. So therefore, you have to keep every single record relating to those trades to justify your tax position with the ATO. There's a number of reasons for this. Obviously, things like the CGT discount come into play. Justifying that you've held the asset for the full 365 days, it's basically just the main thing is just making sure you regularly keep track of those trades and keep on top of that, the record keeping that's required, because ultimately the onus comes back on you if the ATO questions your tax position. Now, basically with trading on capital account, everything's dealt with under CGT legislation, as I said. So what happens when you incur a loss is it is effectively quarantined against other gains that you may make. So those losses on capital account, they're not able to offset any of your ordinary income. They're only able to offset capital gains made in that year or in future years. So that's something to take into account. The one thing that we have noticed and what people need to be aware of, I'll go into record keeping and things like that in a bit more detail later, but the CGT discount is a huge one. We've noticed there's some of the overseas tax software doesn't actually calculate the 365 days required for the discount correctly. So once again, be careful what you're using for your record keeping. It's also always a good idea to reach out to a tax professional to get those amounts and those calculations verified, because as I said, not every piece of software out there is going to be 100% accurate in compliance with Australian tax law. Now, the second thing I want to cover off is people who are carrying on a business. So this isn't looking at people who utilize cryptocurrency for payments in their business. Once again, any questions like that, feel free to put in the Q&A. I'll try to get to them. But this is looking at people that are traders, so they're actually conducting their trading as a business scenario. And this is a very case-by-case thing. And there's several factors that the ATO are going to look at in considering whether you're running a business for the purposes of trading. Now, obviously, because there's things like loss provisions and stock valuations that come into play, which can be used to great benefit from a tax planning scenario. So there's several factors that you need to be considering. You need to have basically a formal structure to how you conduct your trading. You need to be undertaking active education. You need to have workspaces set aside, things like that, to justify that it's actually a business activity. You can't just simply go, oh, I've got an ABN, so I'm conducting a business of trading. They'll look at things like your volume of trading, and I know cryptocurrency generally, like we do a lot more trading, even as a typical capital account revenue account holder. Capital account investor. We do a lot more trading than what a typical someone who's trading shares or investing in shares would do. So there's a few factors to consider there. Comparing trading volumes to your number of trades to someone who's share trading, for example. It may not be comparative at the end of the day. So as I said, there's things like loss provisions that come into play if you're able to justify that you're carrying on a business. So obviously those loss provisions have restrictions, and the common two that traders would typically pass would be the profits test or the assessable income test. Assessable income test being that you've actually generated $20,000 or more of assessable income from your trading activities. So obviously you need to be dealing with, you know, substantial amounts to have generated that initially anyway, or you've made profit free out of the last 5 years. So yeah, they're typical. There are other tests in accessing those loss provisions, but they're typically the two that traders would more than likely be able to access. The other, obviously, as I said, benefit of being in business or conducting a business of trading is things like stock valuation, because obviously you've got market value, you've got cost, you can look at various factors. So there's a few ways to look at things from a tax perspective each year. As far as things like bad debts go, there may be more scope to recognise losses depending on the circumstances. I'll touch on some of those as we go through the later stages of this webinar, but specific questions, once again, I'm happy to come back to those. And you know, there's always a downside to everything though. As I said, carrying on a business has some benefits. But you know, if you do end up holding assets for a long time, there's no CGT discount either. So there are a few downfalls in that regard. Now, staking income, bit of a pain as far as you know, taxation is concerned, especially you know, people that have incurred losses in relation to staking in, you know, staking platforms and things like that. So typically, yeah, the ATO's view is that staking is treated as ordinary income. So it's the same as interest for all intensive purposes. Now, basically that means you've got to report it Australian dollar value at the time of receipt. It's taxable in the year it's received. It's not when you sell it. Now, that dollar value then becomes a CGT cost base in when you sell it. Problem with all that, as you might be starting to see, is that if for some reason you lose those assets, effectively you've earned income that was on that's classified as ordinary income and is taxable. Loss is effectively quarantined on capital accounts. So if you don't have any gains to offset that loss against, you've kind of stuck without any tax benefit to the loss, but you still had to pay tax on the income, which is kind of a very unfair scenario and something we're hoping that the Board of Taxation Review sorts out later on this year. So look, one of the main things, because as I said earlier, you know, the ATO, it's the onus is on you to prove that you're doing the right thing, and that you know, the tax position that you've reported is the correct one. So all trades must be recorded in Australian dollar value at the time the trade occurred. I've seen some people do this effectively with spreadsheets. A lot of the time, you know, the tax crypto tax calculation software does come in quite handy for at least keeping track of all the trades and converting them to the Australian dollar value. But you know, yeah, as long as you're able to accurately convert them to the Australian dollar value at the time of trade. And obviously, you know, using something like a digital search, well, platform does all that for you, so makes life quite easy anyway. And the same will be with most Australian exchanges. I can't emphasize enough to download your trade history regularly, because if something happens and platforms get shut down permanently, you may not be able to recover those records. Now, depending on how the exchange has operated, in the past, we've been able to reconstruct data from public blockchains for clients, using various crypto tax software, drawing information from wallet addresses, or even going to the point of manually, going through transactions on the blockchain to try and rebuild where the client's sort of position is, and try and find sort of missing transactions and things like that. So it can be done. It can be a very painful and time-consuming process. So once again, if you're sending your poor accountant on that down that path, it may end up quite expensive for you. So as I said, just download your trade history regularly, keep on top of it. No matter how you do it, if you do it on a spreadsheet, if you use record keeping software, just stay on top of it as you can. I try to tell my clients do it at least every month. But it's entirely up to you at the end of the day. But just remember that onus falls back on you with the ATO. So as individuals, you need to be keeping these records for 2 years, period from the time of sale. So don't go, I purchased these assets 2 years ago, so I don't need to keep any records relating to them. You need to keep all the purchase records, everything relating to the asset, 2 years from the date of sale. I say 2 years because the period of review from the ATO for individual returns is 2 years. Now, there can be exceptions to that, but you have to be doing, you have to be engaged in outright fraud and things like that. So just be aware of that. For a general individual, providing you're doing your best to do the right thing, there's only a 2-year period of review for those records. Some entities will need to keep it for 4 years. So small business entities are the same as individuals, but entities that aren't small business entities, so you might have a trust, for example, that you've got cryptocurrency investments in, or some other type of passive investments, ETFs or something like that, even real estate. Those trusts actually will have a 4-year period of review. Now, there's other complexities with trust loans and inter-entity loans with companies and things like that can come into play. But I won't go into that in this webinar. Once again, specific questions around that, feel free to reach out, and we'll see what we can do. Self-managed super fund, we'll deal with some self-managed super fund stuff on the next slide in a bit more detail, but they have more onerous record keeping requirements. So there's a few aspects to that. Ironically, from my perspective, you should be recording your sales purchases across your company minute and your company minutes. So I mean, effectively you're having to keep those records for 10 years of all your sales and purchases anyway, because you're required to keep your minutes for 10 years. But from a tax perspective, the record keeping requirement of trustees is to keep those records for 5 years from the date of sale. And as I said earlier, crypto tax calculation software may not be comprehensive enough to complete returns without getting additional advice. It depends on what software you're using, where the software is based. As I said, some of the ones that are based overseas just don't quite do the trick, or they won't do the calculations correctly for, say, a self-managed super fund or something like that. I did see a question about CGT on self-managed super funds, which I'll come back to that when we do the Q&A. A few quick dates to remember. Well, if you're a self-lodging individual, 31st of October. So if you're going to take on doing your taxation return yourself, financial year ends on the 30th of June. You've got to the 31st of October that year to lodge your tax return. That's why it's always a good idea to reach out to a tax professional, a tax agent, and if you're on a tax agent register, on the tax agent's agent list, you'll find you've got longer lodgement dates as we'll go through. Now, I appreciate that some of Digital Surge's customers may be self-managed super funds, and there may be new self-managed super funds. So in that case, you'd have a lodgement date of the 28th of February. So 28th of February, the year following, so financial year ends in June 30, 28th of February. So 28th of February was just gone. Any new self-managed funds should have lodged their return for the 2022 financial year. Now, all other entities, 15th of May. So if you're lodging through a registered tax agent, 15th of May is your lodgement date. They, in some circumstances, they may be able to extend that lodgement date out to you till the 5th of June. But that's more if you're in a refund scenario, or if you've got, you know, the capacity to pay that fairly quickly. But once again, the ATO are fairly flexible with debt arrangements and things like that. So, I mean, if you're worried about lodging or holding off lodging because of something like that, it's probably better to just lodge and reach out to them and have a discussion about the best way to manage it. So look, I wanted to touch on self-managed super funds, just because I appreciate there are some self-managed super funds in the that do use digital surge, and you know, there's some issues that we've commonly come across with funds that we've picked up as clients that have cryptocurrency investments, but I just wanted to raise, and so just to make people aware of. So compliance with the trust deed is a huge one. Making sure that you're only purchasing appropriate asset classes allowed under the trust deed, things like that. Making sure that, you know, everything else is compliant with what's listed in the trust deed. Ultimately, it's the governing rules of the fund. It's what the auditor is going to look at, you know, as to, you know, are you allowed to acquire those type of assets and things like that. Make sure your trust deed's up to date. Make sure it covers the assets that you're buying and that you're looking at. As part of that deed, as part of what the fund is allowed to acquire. And certainly, you know, if your deed is old, look at updating it, because it's probably not compliant with current legislation either way. Now, the biggest problem we tend to see is appropriate investment strategies. Yes, there's plenty of templates out there that'll be good to have a go at yourself. But whether it's such a good idea and whether those investment strategies are ultimately compliant if the ATO was to look at them. Look, I appreciate there are auditors that will just sort of go, oh yeah, that looks good enough, and sort of sign off and things like that. But I mean, you know, if the auditor goes through the investment strategy in a lot of detail, or the ATO simply looks at your investment strategy, doesn't cover the acquisition of those assets, it doesn't cover the proportion of those assets that the fund's allowed to acquire, it doesn't cover strategies to effectively manage those assets. Yeah, it's something that you actually need a fair bit of financial acumen to write correctly. And there's pretty detailed legislation around trustee obligations. So in how the investment strategy needs to be prepared and what it needs to cover. So if you do have a self-managed super fund and you haven't put a lot of thought into your investment strategy so far, I'd strongly urge you to go and look at that, the links on the ATO around trustee obligations and the investment strategy, and you know, have a think about whether that's, you know, what you've currently got is going to get you across the line, or if you need to reach out to someone in the financial planning industry or something like that to sort of get it into alignment the way it needs to be. Now, related party acquisitions can be a bit of an issue. So you are allowed to transfer listed securities, and you are allowed to transfer business real property. Sorry, I missed a little word clarifying on my slide there, but just be aware that's business real property. You're not allowed to transfer residential real property. into a fund, only business real property. So listed securities, business real property are literally the only two assets you can do a related party transfer into the fund, related party acquisition from. So unfortunately, digital assets are outside the scope of the legislation at the moment. Who knows, as legislation evolves, maybe that will change, but as current things stand, that's what you need to do to comply. The other thing, coming back to that investment strategy, is the provision of running costs and payment to members of things like pensions or lump sum drawdowns if they require them and things like that. So you've got to be careful on the liquidity of your investments, obviously, to an extent, to ensure you're able to manage those things. But once again, reach out to a qualified financial planner or if you need help, structuring these things within your fund. Just quickly touching on ownership, you have to ensure that your funds are held in separate account for the SMSF away from your personal funds. I can't accentuate that enough. We see it so much where people have just got a little bit lazy with setting things up, and things end up in wrong names, and you end up with all these kinds of issues when audits pop up and stuff like that. So just be aware of it from the start, and basically make sure that you're setting up your self-managed super fund as a completely separate account. When you're dealing with digital assets, they set up a completely separate account to deal with it, preferably on an Australian exchange. Obviously Digital Surge, and there's other Australian exchanges that have the capacity to set up an account specifically for a self-managed super fund. That's really the road you should go down with that, just to make sure the account names and the way it's set up is in a compliant manner. The other thing we tell our clients is consider storage in a hard wallet. Ultimately, it's your decision at the end of the day, and the trustee has to make that decision, be responsible, and under the trustee obligations, be responsible for those assets. So obviously you need to make due consideration as a trustee there and understand those obligations and what's the best way to deal with them. So now we're going to cover off the events of 2022-2023. So we've been in contact with the ATO in relation to Digital Surge's customers. We're currently talking with the early engagement team, a number of their CGT specialists on that team to confirm from the ATO's perspective if there's going to be any little intricacies that we haven't picked up as to this date. But look, we have gone through the legislation, obviously currently as it stands, the events that have happened, and obviously tried to give you a bit of oversight as to how things should play out. But we will update things from ATO guidance now, as we get it, and this will be published to the Digital Surge website and distributed to all our customers and things like that to help your accountants prepare, or always feel free to reach out to us. Now, what I've put up there is a statement. When I was digging around legislation and doing a bit of research, I come across something that someone else had posted on the ATO community forums there. I put up a link. Feel free to go and have a look at it. I think it's a closed question now, or it's regarded as answered. So what the ATO's looking at is effectively saying that you don't have a CGT event when the platform went into administration, when the creditors trust was set up, or with the movement in your assets. However, you need to consider the tax position you receive a distribution when you receive a distribution from a trust. Now, we went over the question and the way the question had been worded, and we believe there's a few probably discrepancies or flaws as it stands in the way the ATO's addressed it, primarily because of the way the question's been put across. We don't think the ATO has considered some aspects of it, and we're currently in communication with the ATO regarding that. Now, if you want, so the views that I've discussed with the engagement team, early engagement team at the ATO. There's a few intricacies to this. And it's a very unique situation. What we're trying to give you here is the best guidance that we've been able to obtain in dealing with the ATO and researching tax law as it stands. But as you have to understand, it's a very, very unique situation, and there's nothing like this specifically that there's tax rulings on, or there's any specific ATO view on, or anything like that. So it's a very evolving scenario. That all said, we think this is going to be a fairly accurate outcome. So basically, the assets that you have upon regaining access to your accounts, they will hold the same acquisition date as when you initially acquired them. They'll retain the same cost basis as when you initially acquired them. Now, I'm only talking about the assets that you actually got back. We'll deal with the other 43% of assets that you haven't got back at this stage. A bit later on down this slide. So those assets, look, from my perspective, there's no CGT event. The assets effectively move to being held on trust. They will return to you from the trust. There's no CGT event at that point because they were originally your assets. So you had because you had a right to those assets automatically. Under the whole arrangement, there's no CGT event on that specific part. Now, let's deal with the other 43% of your assets, because this one's giving the ATO a lot of pain, and it's taken a sort of lot of time to sort of guide the legislation. So our view currently is the 43% of assets that you've disposed of give rise to a CGT event. But there's a number of reasons for this, and it's all the way the assignment works under the deed of arrangement, the company deed of company arrangement, and the voluntary administration process. So there's a few complexities that obviously come into play here. But on a simplified aspect, 43% of your assets are gone. They were lost due to the issues that happened with the custodian arrangement with FTX. Now, those obviously, what you've effectively got is you've got a right to a debt. That right to a debt is actually a replacement asset in its own right. It has its own value. So you don't just get a loss, a capital loss for that 43% of assets. We've got to consider the market value, the cost base of those 43% of assets versus what you've received as the value of that right to that debt under the trust arrangement. Now, we'll put up, and as obviously we get information from the ATO and more detailed discussions with the ATO progressing, we'll develop calculation statements and things like that, and make it nice and easy, give you things nice and easy to give your accountants to make processing your tax fairly easy and painless, and we'll work around things like that. But as it stands, so there's a capital loss, but obviously there's a capital disposal, and then you've received an Australian dollar value of that debt. So there's effectively there's a CGT event at that point. Now, what happens when you get the subsequent distributions with the trust, well, the value of that debt interest that's now existing in that trust, it's not going to vary at all. So my view is that the CGT arrangements are dealt with for that 43% of assets within the current tax year, while the trust distribution in itself is a distribution of that debt right, that you've got a distribution to extinguish that right of debt. Now, in the event that we get to the end of the creditor's trust and everything's extinguished, and you haven't been paid that full entitlement, another CGT event will occur, which will give you another capital loss. And B, as you can appreciate, it's a really technical area. So I've only really focused on people holding on capital account. Once again, you've got questions about holding on revenue account, feel free to reach out in the questions. I can certainly address them, or if they're, once again, if they're too technical, I will certainly look at coming back with some information to be emailed out. Now, obviously, as well as what happened to Digital Surge, we appreciate, what we've been seeing with many of our clients is there's been exposure to things like FTX, there's been exposure to Celsius, there's been exposure to Terra. Now, I'm not talking about the Digital Surge FTX scenario about the custodian arrangement. That's all being dealt with under the creditor's trust. However, what I'm dealing with here is direct customers of FTX or Celsius. Now, the problem with these particular scenarios of FTX and Celsius is, as you've been aware if you're following them, all the court proceedings are ongoing. Now, because the court proceedings are ongoing, there's been no declaration of value by the liquidators or administrators. And hence that means there's no capital loss that can be claimed on either of these events at this stage. From my understanding, a lot of Celsius customers are going to get paid back 100%, but it just depends on what type of platform you were invested in. It's just going to take a matter of time. The thing to remember with these scenarios is ultimately you're waiting on the liquidator to make a final statement of value on the claims before a tax loss exists. Now, the only differential to that scenario is if you had a liquidated CFD position as part of the FTX scenario. So if you had a liquidated CFD position, there is a tax loss there. CFDs are dealt with under a very specific tax ruling, 2005-15, I think, off the top of my head. But once again, anyone got questions about that, feel free to reach out, feel free to put something in the question box and I'll see what I can get to. Now, the other thing that we obviously want to cover off is just Terra, Luna, what happened there. So obviously the price crash, huge issue. Now, if you held on to your Terra, Luna, you're still holding it, no CGT event has occurred. Effectively, those assets are still trading on exchanges despite their massive loss in value. You'd have to sell them effectively to realise any loss with those assets. Now, be careful of things like wash trading as well. If you go, I'll just sell them and rebuy them and things like that, because that doesn't really work with the ATO if they start looking into things. Now, obviously, once again, Terra, if you're a Terra Luna holder, you've got a new asset. Now, my view on this particular one is it wasn't trading on exchanges at the time the distribution was initially made. Hence, it's a new asset. It's an initial distribution. Therefore, it has it has no tax impact, but when you sell it, it also has no cost base. So basically, whatever you sell it for, that's going to be a capital gain, regardless of what's happened with that original asset of Terra and Luna. So, questions? So, I'll just work through the questions. So the first ones I've got up here: do self-managed super funds get a CGT discount? Yes, they do, but it's not as much as what a individual or a trust would get. Basically, a CGT discount for a self-managed super fund is only 1/3. So there's a few issues there. So yeah, I mean, obviously you've got to take that into account from a tax planning perspective and stuff like that within your self-managed super fund. But yeah, 1/3 discount for assets in a self-managed super fund that have been held over 12 months. So there was a question about the liquidation of assets by court member, and so as I tried to explain there, 43% of those assets weren't effectively liquidated. They were gone under the whole FTX arrangement. So that's how we've tried to analyse that from a tax perspective as well. Obviously, as I said, that's how those losses come into play. But once again, as I said, we'll post more detailed information and things like that for everyone as the ATO provides us with further guidance and what their position's going to be. My favorite one, personal use assets. Thanks, Hugh. We get this one a lot. When's it a personal use? When's the original intention to acquire something? It's such a circumstantial thing. This can go into private rulings and go into sort of dealing with early engagement teams and things like that when these questions come up, especially when you're talking significant amounts of money. Look, typically the ATO's view and what they try to enforce is simply, if you're buying it to specifically buy another asset or another asset or another good, another service, and there's effectively a short term between you acquiring that cryptocurrency and you effectively using it to buy said service or said goods, then basically what they're looking at there is what are the holding periods? Do you have significant other cryptocurrency investments? How have your intentions differed? As I said, it can be so circumstantial. I think that's quite an interesting one. But it would depend on what sort of circumstances you're talking about. For example, look, I mean, my favourite one, look, if you're buying things like gaming NFTs for the purposes of gaming on the Ethereum network, and you've got bits of Ethereum that you're using as part of that. Maybe you can stretch that argument out. It's depending on circumstances and what you're doing with those other assets. If you're trading significant volumes of NFTs and making heaps of profit off it and things like that, you're probably going to have a hard fight saying, they're all personal use assets. If you're buy some NFTs and go and play a video game for 3 or 4 years and then sell the odd 1 or 2 of them because you want to buy 1 or 2 more, then you've probably got a good argument that you've got that personal use intention, and that's something that can be quite long term. Just to sort of give you an idea of how varying the scenarios can be with these type of things. What are the tax implications for the loss that was taken? As I said, I think I've explained that one. It's basically going to be looking at the concept of what you're receiving as that debt value versus what the asset values were for capital gains tax purposes. So it's just understanding from that aspect. And as we said, we'll keep progressing advice as we get more guidance from the ATO, because as I said, it's such a unique and difficult situation to sort of run through the technicalities of. But ultimately, yes, there will be some degree of loss depending on where you've purchased your assets at. So just things to consider. Market value of what that debt that you've got there that you're now owed, versus what you've initially put into those assets. So you've got to have a look at it from that perspective. Because what you've always got to remember is the ATO doesn't look at unrealised gains. They look at realisation points. So that's how the tax perspective is going to flow through. So staking income from the ATO's perspective, why I would consider staking income to be treated differently to the current position. What I've stated is the ATO's current position. Staking income is ordinary income. Dividend reinvestment plan. Well, the dividends are still treated as ordinary income. And the new assets have the cost base of that dividend. It's really the same concept. I think maybe you missed what I said there, Mark. Anyway, well, feel free to come back to me, or I can reach out to you and sort of explain in more detail. I'll give you a few links to the ATO stuff that I'm referring to. Do I have any recommendations for tax recording software? I tend to steer away from this one. Look, I have recommendations which we give our clients. I've got what we use in our practice. But the certain platforms have their pros and cons. Some have an easier user interface that's easy for your general everyday taxpayer to use. Some are more complex and aimed at specifically at tax professionals in order for them to do cryptocurrency taxation returns. There's the general rule I would say is simply look at something that's Australian based, because if it's Australian based, it's going to have taken our CGT legislation into account properly, not just done a quick tweak, looking at, American legislation or something like that, and, done a few quick adaptations to try and adapt to the Australian tax environment and make a bit more income from another jurisdiction. So that's probably the main thing to be aware of there.
I'll just jump quickly in. We had another question here about Coinly. I have registered with Coinly, but I have not used it yet. Does DS API integrates with Coinly? Yes, it does. And we also integrate with Crypto Tax Calculator, with Cointing.com, CoinLedger, and Coin Tracking. So if you are choosing a platform to use, you probably want to use one of those 5 that we're already integrated with.
When you move funds from a paper wallet to do a surge, is that considered a CGT event and another CGT event when the crypto is sold, or is it considered to be a single event due to rollover provisions? And if you're just moving cryptocurrency from one wallet to an exchange, whether it be a paper wallet, a hardware wallet, any type of wallet, there's really no major. There's no CGT event occurring there. It's only on the actual sale. Transfers aren't CGT events in their own right. It's just simply a movement of assets. The one about the crypto 20 tokens, I'll do I'll come back to that one as an actual email. There's a question that's come up about self-managed super funds and CGT, long-term versus short-term gains. Now, I'm not going to deal with how you should be buying and selling your assets in the fund. That's something you need to make a call on as a trustee, and maybe get some financial advice on if you're need to get a bit of assistance there, but not something I'm going to touch on from an accounting perspective, because I'd probably be dealing with dangerous territory with ASIC if I was to do that. So basically, there are some benefits in holding things in a self-managed super fund, obviously capital assets. While the CGT discount is smaller, the tax rate is ultimately also smaller. So you're only paying, say you're at the average tax rate, for example. Your individual tax rate's 32%. So at 32%, you've got your $100,000 gain. So you're going to pay significant. You're going to get a 50% discount on that, but then you're going to pay tax at 16%. Now, once you start going up into the higher marginal tax rates, when I say 16%, I mean the effective tax rate, because you're only paying 50% tax on 50% of the gain. But when you start going up into higher tax brackets, it all depends on your personal circumstances and what your personal income levels are, as to where the benefits lie in moving things into super. If you're in your 40s or 50s, late 40s or 50s, and sort of thinking, oh yeah, look, this is a 10-year thing, and want to sort of look at the gains. Obviously, when a fund shifts to pension phase, as things stand under current legislation, you have, tax-free accounts that are in pension phase don't generate any tax. So basically, you can have a position where you can then sell down those assets and not end up paying any tax because the fund's exempt from tax altogether. So it's very circumstantial, and I'd suggest reaching out to a financial planner and certainly talking about your specific situation if you need some good advice around that. If I haven't actively been trained. If you haven't been actively trading at all since before the liquidation occurred, would it be easier from a tax perspective, just waiting to everything, Well, from a tax perspective, of course, it's easier to wait till everything's known. I think, if you're a trader, and I don't know if you're saying that you're a trader or you're just an investor and you haven't been, doing many buys or sells there. But in relation to that, the assets that are there now, as I said, the cost base will just carry over from what it originally was. So it's just a matter of proportioning cost bases and obviously working out what the acquisition dates of those assets are, and that's something else that we're trying to get some clear guidance on. Obviously it's difficult to say, well, this was this portion of cryptocurrency and this was this portion of cryptocurrency. So it's probably, from the ATO's perspective, it's probably going to be a simple FIFO type scenario in how they apply, what cost bases still exist and what acquisition dates still exist and which ones don't. So I just that's one of the points we're on discussion with the ATO at the moment. So we'll certainly be providing updates around that as soon as we can.
So we're getting close to the hour. We probably have time for one more question, Daniel.
Okay, so how long can you freeze? Okay, so there's one about how long you can freeze CGT losses to use in the future. So CGT losses have to be offset against gains, or can be offset against gains. They don't have to be. So it just depends what type of entity we're talking about, things like that. Basically, your CGT losses carry forward until you utilize them. So until you actually need to utilize CGT losses, they will literally carry forward on your tax return until they've been applied against CGT income.
Great. Thank you very much, Daniel. That was very helpful. We didn't manage to get to all the questions that we have. What we'll try to do is to respond to them in a written format and then email them out to everyone that participated in the webinar. So again, Daniel Harrison, thank you very much. If anyone has any further questions, posted the links to your LinkedIn as well as to the firm's website. Feel free to reach out. Hopefully this has been helpful for you. We will continue to work with ATO and to provide as much information as we can as it becomes available and to share it with everyone. Thanks and goodbye.